welcome to everybody who's is tuning in today. This is our June update, tax update that we run every quarter. The time certainly seems to fly, and doesn't seem that long ago we were doing the March one. But yeah, it's plenty to talk about today. Usual format is myself, Vicky, and Robert will be presenting on separate topics. I'll be doing a bit of a tax, just a general roundup to begin with. Vicky's going to pick up on some pertinent private clients matters, and then Rob's going to finish off with making tax digital, one of the big topics that's around at the moment. As usual, the webinar is being recorded, so you can tune in again later by either going on our YouTube channel, or there will be a link circulated around afterwards. As always, we welcome any feedback on the presentations that we do here. Any topics that you'd like us to cover, please let us know by just dropping us an email. So let's get cracking. So yeah, just a general roundup from myself, and I was going to start off with just the topic of double cab pickups, which has been sort of in the headlines over the last 12 months or so, really. Just wanted to remind you of the changes that have come in from April this year. Now, you might recall that there's been a bit of an ongoing saga with double cab pickups in terms of, are they a car, are they a van? And clearly there are various tax issues depending on which side the vehicle actually falls. And back in, I think it was February last year sometime, the government at the time, they announced that the rules that we have now were going to be brought in from July last year. And then if you recall, about 7 days later, that was furiously backtracked on. And so we were in the position as it was before. And this all stemmed from a tax case, or several tax cases, the main one being Payne, which was also known as the Coca-Cola case, referring to the people they worked for. But nevertheless, we came around to the budget in October last year, and we're now in a scenario where from the 1st of April this year for corporation tax, and the 6th of April for income tax and national insurance, double cab pickups are to be treated as a van only if the construction of the vehicle at the time of construction means it is primarily suited for the conveyance of goods. And that's the key phrase here now, primarily suited. So we're not worried about whether it's what the payload is anymore, aside from, as you'll see there, VAT. So we do still have a different definition for VAT purposes than we do for direct tax purposes. Now, the new definition means in majority of cases, probably in most cases, double cab pickups will be treated as cars for corporation tax and income tax purposes. So what does this phrase mean? Primarily suited for the conveyance of goods. I suppose one of these things, if it looks and feels like a car, then it probably is a car. If it's got 5 seats, so two rows of seats in it, then it's probably a car as well. Now, there are some transitional arrangements for vehicles that were acquired pre-April 25. And so from a benefit in kind perspective, if the vehicle was purchased, leased, or ordered before the 6th of April, the old rules will still apply until the earlier of the disposal, lease expiry, or the 5th of April 2029. So if the vehicle previously was classed as a commercial vehicle for benefit in kind purposes, then that treatment will continue until the earlier of those 3 dates. Similarly, for capital allowances purposes and for the purposes of restricting the amount of deduction for lease charges, the new rules apply for expenditure incurred on or after the 1st or 6th of April 2025. Now, also, expenditure incurred up to the 1st of October this year will also be treated as still being under the old rules, where the contract was entered into before the 1st or 6th of April 2025. So there are a few transitional rules there to bear in mind as well. But in essence, going forward now, any new vehicles bought now, any new double cab pickups acquired will more often than not be classed as a car for tax purposes, other than VAT, where the payload is still the relevant factor. Just want to run through a few other changes from April this year. Again, very much as a reminder, employers NI, everybody will be aware of this, I'm sure, by now, but that's now at 15%. The secondary threshold for NI is reduced to £5,000, but the employment allowance has gone up to £10,500. We've got changes to the taxation of non-DOMs, which Vicky has spoken about previously. They're coming in now. Tax return disclosure for 25-26 tax returns onwards. There's now, or there will be, a requirement to confirm if the individual is a director of a close company. Also to be required will be details of dividends received from that close company and the percentage of shareholding that individual has. So clearly there's an effort here from HMRC to try and match up dividends declared by a company according to the accounts and Companies House records with those being declared on the tax returns of the relevant shareholders. And we are aware that historically that HMRC have been checking, for example, persons with significant control in companies from Companies House records and trying to tie those back to tax returns and dividends. Something like this may mean that things like Alphabet shares may start to get looked at a little bit closer, or where disproportionate dividends are being taken compared to the shareholding of an individual. So more data being gathered by HMRC as part of the tax return process. This is from 25-26. Along similar lines, or additional disclosure that's required from 25-26 are details of the date of commencement or cessation of trade. I suppose in a lot of places that may be included anyway, but it's only voluntary at the moment. It will be mandatory going forward. Capital gains tax, again, something we've spoken about at length before. Just a reminder, we're now into a 14% rate for business asset disposal relief qualifying disposals, and that's going up to 18% from the 6th of April next year. Furnished holiday lettings have been abolished, so now any FHL business is just treated like any other property business. There's an increase in the rate of late payment of tax. It's now at 8.5%, which is quite an eye-watering amount. It's been reduced to 8.25 from the 28th of May, just gone, so literally last week, hot off the press. Repayment interest is 3.25%, again from last week, from 28th of May. So still a big arbitrage between those two rates, but certainly the days of perhaps using HMRC as a bit of a low-cost lender, I suspect are well and truly past now. And going forward, the rate of interest for late payment of tax will be the base rate plus 4%. Moving on to crypto asset reporting. Now, this is an area where HMRC are are perhaps a little bit behind the curve, and due to the nature of crypto in general, they don't necessarily have a great deal of visibility in terms of the transactions that are being undertaken. So this is all part of a drive to try and capture more data around crypto transactions. So they've released guidance for crypto asset service providers in the UK, which means that from 1st of January next year, those providers will need to gather information about their users and those transactions and report them to HMRC. The first reports are due in May 27, and this is all part of a general crypto asset reporting framework from the OECD. So this is not just a UK government initiative. It's wider than that. And the maximum penalty for non-compliance by the service providers is going to be £300 per customer. So that could be quite significant in certain circumstances. And HMRC have said they will be providing more guidance in due course. So, like I said, this is just another tool in HMRC's armory in terms of making sure that crypto transactions are being properly captured and properly reported by taxpayers. HMRC advisory fuel rates. There have been a cut in some rates from the 1st of June this year. You'll see on the slide there. I won't go into these in any great detail, but petrol is 14p down from 15 for 1400 to 2 litres. Over 2 litres, it's down a penny to 22 pence. Diesel up to 1600. 1.6 litres is down a penny to 11 pence. All the other rates are the same. So those rates apply from the 1st of June. Another consultation that HMRC have released recently is around transfer pricing. And this could have some impact in the SME space. Historically, we haven't been overly concerned about transfer pricing because of the exemptions for small and medium-sized enterprises, which means that largely they are exempt from the transfer pricing provisions. However, there has been the release of draft legislation for consultation, which is narrowing the scope of the exemptions for UK to UK transactions, and also replacing the diverted profits tax with something that aims to do a similar kind of thing. I won't go into that element because we very rarely or at all see that. As far as the transfer pricing provisions are concerned, the proposal is to remove the exemption for medium-sized companies and groups. So a medium-sized company or group is one that has less than or fewer than 250 employees and annual turnover less than 50 million euros, or an annual balance sheet not exceeding 43 million euros. Now, small groups and companies are still going to be exempt, and this is less than 50 employees and a turnover and balance sheet of less than 10 million pounds. There will be a general exemption between UK companies on transfer price for UK companies where there is no risk of tax loss, but there are going to be some exclusions for that. So it's not a blanket exemption. Nothing immediate on this, given that the draft legislation is out for consultation. I suspect there might be something in the next finance bill later in the year. But what it does indicate, though, is there's likely to be more of a transfer pricing risk for medium-sized groups, which will clearly mean more compliance and an admin burden in terms of documenting transfer pricing policies and methodologies and such like. Some good news, which was announced recently, was around the payrolling of benefits in kind. Now, you may recall there was an announcement made last year whereby payrolling of most benefits in kind was going to be mandatory from the 6th of April 2026. That's now been pushed back a year. You'll be pleased to hear, to 6th of April 2027. So it gives more time for everybody to prepare, both companies in terms of getting their own internal systems sorted, and also software providers as well. As noted in the initial announcement of this, there will still be, it's still possible for beneficial loans and employer-provided living accommodation to be excluded from these provisions, but it will be mandatory for all other benefits. So a welcome delay there. And finally, I just wanted to make you aware of a recent spotlight that had been issued by HMRC, Spotlight 68. Now, for those who may not be aware, spotlights it's a mechanism whereby HMRC make us all aware of schemes that they have identified of having the features of tax avoidance. And the aim of the spotlights is to essentially warn against using the schemes on the basis that HMRC will challenge them. Now, the first spotlight was back in August 2010. So they've been around for a good number of years now, and we're actually up to number 70 in total. But this is one that I've actually seen this being marketed, and it's one of those ones where you do kind of raise your eyebrows in terms of as somebody who's actually got the gall to think something like this up and then to try and sell it to people, where clearly it sort of doesn't work. But nevertheless, it's out there. So this scheme is it's been marketed, aims at reducing the corporation tax liability by including expenditure for advertising in the profit and loss account of the company, and having that as being a tax deductible expense. But the way these schemes are purported to work is that an amount equal to 80% of that spend is returned personally to the directors and employees in the form of loyalty points. So this is all done through like a prepaid debit card type arrangement. So those loyalty points are immediately converted into monetary amounts charged to those cards, which the directors, employees, etc., can then use for personal expenditure. Unsurprisingly, HMRC's view is the scheme does not work and will challenge anyone promoting such arrangements. And I think I'd say, good luck to anybody who tries to defend that, because it certainly seems one that's destined for failure. Well, that's enough from me for now. I will pass you over to Vicky to go through some private client matters. Thanks, Vicky.
Thanks, Craig, and good afternoon, everyone. The first thing I'm going to talk about is inheritance tax, and picking up and extending some of the comments I made in previous sessions, because obviously the tax landscape is changing very significantly as a result of the budget changes that were announced in October. The rules still aren't in yet. We don't have all the details, but obviously they're very, very topical, and lots of people are wanting to explore what they mean and the impact that they've got on their family situation and the legacies they're planning to leave. So the proposed changes do impact many families, current plans that they had for how they would transfer their wealth down the generations. We don't have all of the detail or the legislation yet, and it could be very close up to the date of these changes coming in that we do get the actual legislation, which obviously is very difficult to plan around. But at the moment, we have to go with the information that we have and assume it's coming in. Whilst the rules, very much do affect people with agricultural property, business property, and significant pension funds, those holding tax-favoured assets, it may still be possible to leave up to £3 million worth of assets tax-free for married couples. So that's looking at using the £1 million agricultural business property relief or business property relief allowance that each of a married couple could have every 7 years, plus the fact that a married couple that has either one of them assets of less than £2 million, they could get up to £1 million in terms of the normal mill rate bands. That's 2 lots of 325,000, and then the additional residence nil rate band of 175,000 each. Obviously, this is the ultimate maximum that they could get tax-free, because otherwise the residence nil rate band starts to be tapered away where one of them has assets of more than 2 million. But I think, you know, there are people that estates would still fall within that threshold. But it really is sensible to start having discussions and think about the effect these changes are going to have. But really, it's also important not to panic and not to rush into making decisions which could be regretted, or which you might not have done if there end up being any changes in the future. It's important as part of this to remember that the taxation of lifetime gifts has extra taxes applying to it, as opposed to ones on death. And lifetime gifts, if it's anything other than cash, you have to make sure you're thinking about the inheritance tax and the capital gains tax impact, because both of those taxes would apply. So lots of individuals would need to review their wills to ensure that they're capturing any of the favoured tax release efficiently. And it is sensible to keep wills under review and revisit those every, say, 5 or 7 years, just to check they are still up to date and what individuals want. And if there's change in circumstances, either within the family itself, you know, if individuals are retiring, they've changed the nature of their assets, or like this, where we've got big changes in tax legislation coming up. Valuations are going to become increasingly important because it's no longer going to be the case that if you've got full business property relief or agricultural property relief, that the value doesn't matter. And because there's going to be more IHT to pay in many instances as a result of these changes, life insurance is likely to play a larger role in people's estate planning. Obviously, that can get quite expensive, but it is something that people will be looking at to provide funds towards their inheritance tax liabilities. Now, some good news is that the instalment option for paying inheritance tax due over a 10-year period is going to be available, they've said, for all agricultural and business property from the 6th of April 2026. So that is something to remember, although obviously there needs to be a way to generate the funds to pay the instalments over those years. And there is some limited scope for planning before these changes to the business property relief and agricultural property relief come in on the 6th of April next year. If individuals were thinking of creating a trust, then there could be advantages in doing it before then, because it would allow more value to get in potentially. And equally, it may be possible or more possible to extract funds out of a trust before these changes come in if they qualify for 100% relief at the moment. So moving on to the next slide, then this is just a reminder of more of the detail in terms of these changes to business property relief and agricultural property relief. So the 100% rate will only apply to the first £1 million of eligible property, and the balance over and above that will be taxed at 50%. And the rate of business property relief, it will be reduced down to 50% for shares in AIM trading companies. And so because they will only get 50% relief no matter how many AIM shares are held, the £1 million allowance is not applicable here. The £1 million allowance only applies if individuals have assets that would qualify for 100% relief, or indeed trusts. So also, property that currently only attracts relief at 50% for business property relief purposes will continue to do that, and again doesn't count towards that £1 million allowance. So examples of where that can apply would be where individuals hold, for example, property personally, and that property is used either in a company of which they're the main shareholder, or of a partnership of which they're a partner and it's used within that business. Where an individual's £1 million allowance isn't fully utilised by the time they've died and when they take into account their assets on death, it can't be transferred to a surviving spouse or civil partner, and it applies across the whole of the estate on their death as well, these changes, as well as any failed gifts or chargeable transfers. So the £1 million allowance has said that it will renew every 7 years, and it can also have an impact on trusts that have these, and there's slightly different rules on those, and the outcome of a recent consultation on that is awaited. So they've also brought in anti-forestalling rules, which I did mention the last time we talked through these rules, and they apply where there's lifetime transfers between the October budget day and the start of these new rules coming in. So the new regime will apply to lifetime gifts made between these dates, where there is the chargeable event, which would be, for example, death of the individual that's made those gifts after the date the rules come in, so after the 6th of April. But if there's a lifetime transfer between these dates and death happens before the changes actually come onto the statute books, the existing rules will apply, so you'd still get full business property relief, for example, and it wouldn't be limited to the £1 million. It will also impact trusts with qualifying property. As I've said, there are some differences in treatment with that £1 million allowance, and there are differences in how that will be treated between where the settlor created multiple trusts before and after the 30th of October. So just to give some examples to these, so if you've got a failed pet and chargeable transfers that have been made before the 30th of October, they're not subject to the £1 million limit, and they don't use any of that because they were under the rules that were in place before the announcements on that budget day. If there have been transfers between the 30th of October and the 5th of April, we have to look at what's happened afterwards. Pets won't be subject to that £1 million limit, and it doesn't reduce that limit if the death happens before the 6th of April, as I've said. If it's a pet and the individual survives the gift by more than 7 years, it's exempt, so it doesn't feature in the calculations. Chargeable transfers, so that would be transfers made into trust, they're not subject to the limit and don't reduce that £1 million allowance if the death happens before the 6th of April. And the same applies if the donor survives for 7 years from the date of that chargeable transfer. Otherwise, they are subject to the limits, and it reduces for the purposes of future transfers. So it is complicated. It is taking time for us all to get used to these new rules, but hopefully that does expand on those a bit and is helpful. Then as well, just to give a reminder of the IHT and pension changes that are coming in a year later from the 6th of April 2027. Again, we don't have all of the detail on this, but it is said that it's going to apply to unused pension funds and death benefits from discretionary schemes, and that they'll be treated as part of a deceased estate. So again, this is a big change for individuals, and it does mean that far more assets are going to be subject to inheritance tax. Now, this can lead to a potential triple death tax, where the individual whose pension fund it is dies over the age of 75, and they've got unused pension funds that they haven't drawn down during their lifetime, because there would be inheritance tax liability on the pension unless they've got, unless it's covered by their nil rate bands. There would be an income tax liability on the withdrawal of the pension. So that would be anything that the beneficiaries are going to take out of that pension once the inheritance tax has been paid would be subject to income tax as the deceased over 75 when they died. And there could be an additional effect on the estate of the deceased, because if this causes their estate to be over the £2 million amount, then their residence nil rate band would start to be tapered away as well. So the actual percentages of tax that we're talking about here can get quite eye-watering. And so it is something that people are looking at using and thinking about what they should be considering with these assets. So it does feel like there's less incentive to retain money in pension funds, and that's something that the government is wanting. The idea is that they want people to have pension funds that are spent before they die. But it must be remembered that the changes don't come in until the 6th of April 2027 for pensions. There is still benefit in saving into a pension because there's gross roll up and no tax until the money comes out eventually. There's the tax relief on personal pension contributions, and it is still possible to take the 25% tax-free amount upon retirement. So some of the things that are being considered are, if the tax-free amount hasn't been taken, is it time to revise that strategy and aim to take it before the person dies? Because otherwise that tax-free allowance would just disappear and the beneficiaries will be paying income tax to get the funds out of that pension scheme. Reviews of the pension expression of wishes and what's going to happen to that pension fund it needs to be considered. Because in the past, when it was in an IHT-free environment, if the spouse didn't need access to the funds, you'd typically say to pass it to other people rather than the spouse. But now, because it's becoming within the inheritance tax net, it's thinking about, you know, whether it should be passed to the spouse, and then that delays the actual payment of the inheritance tax and gives more opportunities to spend that money without inheritance tax being due on it. Do you draw the pension income from it, suffer the income tax charge, but then see whether that's allowing you to gift it away under the regular gifts out of income from inheritance tax and not suffer the double income tax and IHT charge? And do you use withdrawals to help you fund the whole of life assurance that could be expensive but would provide a pot of money to help with the payment of inheritance tax in the future? So hopefully these are things that you've heard me talk about in previous sessions and are very topical at the moment, and I'm sure we'll be exploring them more in the sessions to come. Now, as Craig mentioned, there have been significant changes from the 6th of April 2025 to the taxation of non-UK domiciled individuals, and there has been a change in that domicile isn't going to be the key factor here. So what's happened is that the remittance basis of taxation has been abolished for non-UK domiciled individuals from the 6th of April this year. But if those individuals have claimed the remittance basis in the past and would pay income and capital gains tax when they bring those prior amounts back into the UK, those would still be taxed on the basis of the remittances that they're making. So that the remittance basis will still have an effect. It's just that it can't be claimed going forwards. What's happened is that we're replacing the domiciled situation with a residence-based regime. So for income tax and capital gains tax purposes, I'm not going to go into a lot of detail here because it is quite a specialist area, and I think the audience here won't necessarily be impacted too significantly by this. But if you are, then it needs to be thought about the new foreign income and gains regime. There is a temporary repatriation facility, and there will be some possibility of rebasing. Now, that's not rebasing to the 5th of April 2025, it would be rebasing potentially back to April 2017. And in order to have the scope to do that, the individual concerned has to have been a past remittance basis user. So that would be important to look at the rules if you think that would be the case. And it may well be that some individuals might want to think about claiming the remittance basis and forcing yourself to be within those rules. And the last tax year that would enable you to do that would be 24-25, which is the tax returns that are starting to be completed at the moment. So one of the things that I will expand a bit more on is the inheritance tax consequences of these changes. So as a result of these changes, individuals who've been resident in the UK for 10 out of the last 20 tax years, immediately before the tax year we're looking at, which would have a chargeable event in it, so either death or when a gift is being made, that could become taxable in the future. If the individual has been resident for at least 10 out of the previous 20 years, then they will fall within the scope of UK inheritance tax on a worldwide basis. And if you do fall within those rules, then the tail, which is the amount of time that a person remains within these rules once they've managed to sever their connections with the UK and lost their UK residence, can be up to 10 years. And the length of that tail depends on how many years you've been in the UK. So if you've been in the UK for 20 of the previous 20 years, then your tail would be 10 and it reduces down. There are special rules for some non-doms who have left the UK before the 6th of April when these rules came in and who were non-UK domiciled at the 30th of October 2024 and they don't return to the UK. So if they would have been caught by these rules, but they've left before they've actually come in and they don't come back, then they're not. Then there are some special rules that mean that they won't be affected by these if they would have fallen within the old deemed domiciled rules. You aren't treated as a long-term resident in the year after you've had 10 consecutive years of non-UK residence either, even if you return to the UK after that. So there are ways of restarting this clock. But it really is something to consider if you're a non-UK domicile and you have been resident here for a number of years. or if you've been out of the country for a number of years and you're coming back and could fall within these rules. Because there are some winners as a result of these changes, and that includes expatriates that have come back to the UK where they've had a significant period of non-UK residency. So where you've got individuals that have been out of the country, for up to say 30 years sometimes, and they've been working overseas and they come back here to retire, they might well have been born here, think that their UK domicile of origin would reignite when they came back here. But if they fall within these rules, there is a period of perhaps 10 years where they don't fall within the worldwide inheritance tax rules, and it gives them some planning opportunities for overseas assets. And equally, individuals that are planning on leaving the UK long term, where their domicile of origin was here and they've got non-UK assets, could also benefit from these. So moving on here, just to explain it a bit more. So after the 6th of April this year, gifts of non-UK assets don't have a 7-year period that you have to survive if the individual wasn't a long-term resident when they made that gift. And that means that they're not within the scope of UK inheritance tax, even if they die within 7 years of the gift. And at the point that they die, they were a long-term resident. The flip side of that is that gifts made by a long-term resident of non-UK assets will be within the scope of UK inheritance tax, even if they cease to meet the criteria by their death. So it's looking at the position when the gift was made or the event happened. This means that it is necessary where this could apply to review information very carefully, try to keep records, try and make sure you've got it for the 20-year period, and consider the residency position. Now, at the moment, we're looking at various different rules, which would include IR20, HMRC 6, and the statutory residence test. But please remember that UK assets do remain within the scope of UK inheritance tax, and it's only if you had somebody with non-UK assets that you'd want to be looking at this. So moving on to another topical aspect that we're seeing, something I just thought it was worth mentioning briefly, is that we're having questions from people that have been working for a UK company and worked overseas, and we're seeing that there can be complications and cash flow disadvantages where tax isn't paid in the correct jurisdiction and it's being deducted at source. So for example, you've got a company that still keeps somebody on the UK payrolls deducting PAYE on it, but they've gone to work overseas and they haven't been doing any work in this country at all. Any double tax relief claimed should consider double tax treaties. And you must remember that to claim double tax relief, that the tax has to have been validly deductible in the country. If it isn't, then that should be sorted out with the country that's deducted it. We're thinking here that it could have questions to think about as to residency, dual residency and non-residency. If PAY is being deducted and they're not physically working in the UK and not a UK resident during the tax year, then you would need to claim that amount from the UK authorities, and it's likely to have to pay tax in your other jurisdiction, and that you wouldn't take into account the tax that had been deducted at source because that's being repaid. Ideally, non-UK work wouldn't have UK tax deducted where it wouldn't otherwise be taxable in the UK. There can be wider complexities for the company, including is it causing an overseas branch to be created? That can be influenced, particularly whether the individual that's doing the work is generating sales or making operational decisions. With all of this, what's best depends on how long the working overseas is going to last for. Thinking about the UK rules, which would typically be the statutory residence test for residency, and overseas rules and the interaction between the two. And often it can be simpler and beneficial to appoint a payroll agent to make sure the correct deductions are made from salary in the country where the individual is actually working. But this is just something to bear in mind and try and have the discussions as soon as possible if this looks like it's going to be happening. So just a very quick reminder that Craig went through some of the changes that were affecting this current tax year that we're in from the 6th of April 25, but these are some of the things that we're seeing having changed in the tax returns for last year, which need to be submitted by the 31st of January. So we've touched on these before, but they have abolished that 150,000 threshold for individuals that have income that's taxed only through PAYE, so that they don't strictly have to submit a tax return. But is that actually best? There can be effects on other aspects that haven't been included, so that doesn't always give the right answer. crypto assets now have to be identified separately within the capital gains tax pages of the return. And just a reminder that because the CGT rates changed around budget day, within the tax return itself, there are some special boxes and calculations and schedules that need to be taken into account to make sure that the transactions that happen pre and post are taking that into account. So now I will pass over to Robert to talk to you about making tax digital. Thanks, Robert.
No, thank you, Vicky. Good afternoon, everybody. It's an interesting update and very, very complex area. So by all means, please get in touch with Vicky if anything resonates there with yourself and your clients. So making tax digital, unlike the payroll and benefits, we're on the 3rd of June 2025. It is still here to stay and will be coming into effect from April next year. That's despite all the multiple pushbacks and pushbacks and pushbacks. So that is where we are as we currently stand. Deliberately made these slides fairly sort of short and to the point. 2 reasons for that. It's not just because I was being lazy. I think it's probably because we've all seen multitude of webinars and updates and MTD. I think potentially we're all getting a little bit sick of it. But regardless of that, there still seems to be a few areas of confusion with some people. So there will be a little bit of repetition on the slides, just mainly to try and get the key points across, really. The key points being, as we see them, where those sort of areas of confusion arise, and really speaking, the areas of confusion are probably caused by the pushback dates, multiple kind of stop starts, and changes to limits and all sorts of things, really. But that's the first slide there, just a bit of a snapshot as to what it's going to involve. I'm sure you will already know this already, but definitely keeping digital records. So gone are the days where sort of having a carrier bag full of receipts and that's sort of a suitable record keeping, filing system. That's out the window now. Either we, as their accountants or the clients, ideally would need to be keeping those records on a digital format. Quarterly updates to HMRC, much in the same way as a VAT quarter. I'll come on to when those quarters are in a later slide. Importantly, though, there is still the requirement to file a self-assessment by the 31st of January following the end of the relevant tax year. That's not changed. The format, as we're aware, of the self-assessment itself has not changed either. So these sort of quarterly updates are very much just sort of fairly sort of brief, really. And again, I've got a slide coming up which will just sort of discuss that in a little bit more detail. And again, with that fee, no changes to payment dates. So again, sort of 31st of January, 31st of July, nothing sort of changed there. The actual sort of tax itself is computed by HMRC using their own sort of internal software, if you like. So the external software that we'll be using to actually sort of file these records won't actually come up with a tax calculation, albeit I think some of the actual sort of software packages do that just for the sake of keeping a running record, basically. But really, the end of year kind of update and final version is the important one for our clients and their sort of tax position, to be perfectly honest. And again, just to touch on it there, the actual returns, these quarterly returns, do need to be submitted using a third-party software, third party being not something which HMRC offers. They will not be offering any kind of online platform that they will be developing or won't be developing, as the case is going to be, for clients to actually sort of prepare and do these things themselves. If the client wants to prepare themselves, they would actually need to have their own third-party software that allows for filing of those quarterly updates. So this is where the repetition comes in a little bit, and you'll see this coming up in a fair number of times as the slides go on. But again, it is submitting quarterly updates and a normal, in inverted commas, normal self-assessment at the end of each year. But the important thing here is the Making Tax Digital is only applicable to those clients with mandated income types. And the mandated income types for this purpose are self-employment and property income. Self-employment does not include those who are a member of a partnership or it's purely self-employment income. It doesn't include employment income. It doesn't include dividends. It doesn't include any other form of income that's not self-employment or property income. And for the purposes of property income, that does also include foreign property. I think that kind of harks back a little bit to what Craig mentioned at the beginning. There is now no sort of differential between furnished holiday lets and sort of, in inverted commas, normal long-term letting of property, be that commercial, residential, or property income, including foreign property income and purely self-employment income. If the client has both types of income, then that's obviously something that needs to consider separately. And again, I've got a slide coming up which kind of details the actual sort of reporting obligations of that. So again, not to kind of reiterate the point, but recipients of mandated income types only, which we just discussed on the previous slide. The scope here at the moment is going to be a phased commencement, which will be starting from April next year. And that's going to be based on gross income. And we have got some slides coming up which detail how we actually sort of calculate gross income. For sure, you can probably sort of work out yourself. There are going to be some exclusions from this. I've just listed them all there, not intend to go through each one in detail. But I guess the big things there, potentially from our client base, trusted estates don't need to comply with Making Tax Digital. A bit of a strange one. Somebody who is a foster carer, their income from foster caring is not so subject to Making Tax Digital, but they themselves as an individual still may be subject to Making Tax Digital if they have got other income sources outside of their foster caring income. And we've also got those only applies to people with a UK national insurance number. So if you've got perhaps an overseas client that's never lived in the UK, never had a national insurance number, but owns multiple UK properties which are let out, they don't actually need to fall into to Making Tax Digital, so they are excluded as well. I think those are probably the main ones that we would see in practice. Certainly, I mean, to say there are some other sort of exclusions, as you can see on that page there. So again, coming back to this phased introduction. So from April next year, clients will be required to file their quarterly returns if their gross income is £50,000 or more. And that obviously includes self-employment and also includes the property income also. Now, how to actually sort of get to that £50,000 of gross income? We look at the figures from the prior year's tax return. So we are now in the process of preparing 24-25 returns for our clients. It will be those figures that HMRC will use to write to the clients to actually advise them that they will be falling within Making Tax Digital. So now really is the opportunity to kind of start, if we haven't already, getting in touch with clients to say, as from, based on the figures of your 24-25 tax return, as from April next year, you will be required to prepare quarterly returns under regime Making Tax Digital. We will need to register for you, and this is where we can kind of set out what we can do to help them with that. But then we have got this phase kind of introduction of it. April 27, gross income falls down to £30,000 or more. And again, that's based off the prior year's tax return. And then this is what the government has currently said. Before the end of this parliament, gross income £20,000 as from April 2028. And again, taken from the prior year's tax return. So whether or not that's going to be subject to change, we don't know, but we'll just have to wait and see on that. But certainly with this phase introduction, it's going to be catching out more and more clients each and every single tax year as we go by, really. So it's almost sort of worthwhile giving clients with between say 20 and 30,000 pounds worth of gross income, gross mandated income, I should say, to beat my own drum there. It certainly would be worthwhile actually getting in contact with them now just to make sure they're all prepared and ready to go as and when they do fall into the net of Making Tax Digital. So gross income, and again, apologise for repetition, no employment income, no dividend income. It is purely self-employment, not being a member of a partnership, and property income, including overseas property. We'll just have the next slide there, Craig. And this is really where the kind of digital start date comes in. That comes back to the previous stage with this, sliding scale of gross income on which the client may sort of fall into. So as soon as they actually sort of hit that threshold from the 24-25 tax return, or indeed the 25-26 onwards, that is when they are in the scope of being required to file quarterly submissions. They will need to be under the limit for 3 consecutive tax years before they actually remove from Making Tax Digital. So, broadly speaking, even if their business takes a massive sort of drop in income, or, for example, they go to semi-retired or part-time, then they're still probably going to be within the net of Making Tax Digital for at least 3 years. But we kind of think about £20,000 worth of gross income is not in this day and age a huge figure. Will be obviously for many people, but for sort of number of clients with sort of say several properties they let out and a bit of self-employment on the side, that's probably unlikely to make sure that they actually sort of fall out of the net, as it were. From a purpose of actually what required to file and report on, it's purely the P&L, which can get a little bit tricky because if you kind of think the way that some of our clients prepare their records will also include some balance sheet transactions also, but we are only interested in P&L for the purposes of the quarterly submission. And of course, obviously, the digital records are going to be covering all transactions. So on that basis, there's a little bit of leeway from HMRC that we are allowed to use cash accounting if we really wanted to, just to kind of keep things simple. Kind of begs the question a little bit as to what exactly is the point of all of this. But there we go. It's only the P&L that HMRC are interested in seeing on a quarterly basis. Trading income, again, we're looking at turnover, clearly. Any other sort of business income they may have. We can make some adjustments for disallowables at this point, or we can actually say do a catch up at year end when the self-assessment goes in. And I guess the complete set of accounts is prepared. And again, comes back to the point, what's really the point of all that? It's not just giving a huge amount. But clearly, of course, HMRC are trying to capture the daily takings from retailers, tradesmen, that sort of thing. And again, just to return to the point, cash basis for the purposes of quarterly updates is perfectly acceptable. The more correct the records are, of course, the better the tax estimate from HMRC will be. There is some concern that the system could be fiddled with slightly in the sense that if you're not quite ready, you're not quite there, your client's not quite there to get a quarterly submission in, then sort of putting down any old random numbers would do for that effect. But we have had some noise, if you like, that if there's a huge difference, disparity between the quarterly submissions and the totals and the actual year-end submissions, then there would be inquiries open to see actually why that disparity occurred. Next slide, Craig. So property income, again, it's a similar sort of topic. I mean, we are looking at gross rental receipts, before us, obviously, clearly deductions, which will be taken into account from the profit basis. So we are looking to P&L. The jointly owned property can be quite difficult on the basis that, effectively, if you've got a joint owners of a property and they've got separate credit cards they put expenses on, then theoretically you're having to sort of apportion the expenses between each one of them. There is a bit of an easement there which allows you to actually just record the income in an update period, the update quarter that is, and then actually sort of catch up on the expenses at the end of the year. Again, cash basis is perfectly acceptable. Avoid you actually sort of having to go through accruals and prepayments and such like. Property income from foreign source can be slightly tricky as well. There does need to be a record actually sort of capturing the location, if you like, where the actual property is situs, which can actually sort of increase the number of records that actually need to be kept. And again, I've got a slide coming up which talks about record keeping. There we go. Just in time. So all these records do need to be digitalized. They can be kept on one software. Income app, expenses another. There does need to be a digital link between that particular sort of software and obviously sort of the specific HMRC page at that stage as well. Exactly the same as it is for VAT. It is perfectly acceptable for spreadsheets to be kept on that basis. There is some bridging software which kind of pulls it into an external third-party software package which is allowed to be submitted on that basis. That might make it easier for some people, certainly. But this is where it can get quite annoying because, broadly speaking, each separate trade that a client may have does actually require there to be sort of separate records reported on a quarterly basis to HMRC. This can obviously increase potential sort of software licenses and costs in that regard. Also can potentially sort of increase the amount of sort of effort that goes into actually preparing a quarterly return. Luckily, UK property income, you can group that all together into one single submission. But again, that is a single submission separate to the self-employment. Foreign property income, again, is a separate obligation to the other two. So in a realm where you've got a client with two or three self-employments, they've got UK property income, they've also got foreign property income, they could be having actual sort of multiple record keeping obligations and multiple actual submission obligations as well. And that obviously can get quite time consuming. So I think those sort of clients are the best ones to be getting in contact with now to make sure, of course, that they're absolutely ready for this. So again, just come back to quarterly update. It's not a sort of set of accounts. Again, there's no adjustments for accruals or prepayments. There's no balance sheet. It's simply the P&L. You can, of course, carry on and do that as you may wish. That maybe it's quite difficult for some of the the adjustments you may need to make, but it's entirely up to yourselves. So say the basic kind of format will just be simply a P&L for that particular quarter. And obviously there's going to be sort of a cumulative amount from that 25, 26 onwards. So these when the actual sort of quarters are starting. Again, kind of sort of follows the sort of VAT as much as anything else, really. So for say you're starting 6th of April 2026, the first quarter brings us up to the 5th of July 2026. And then we've got a submission date for 1 month and 7 days after that. Now, it is possible if you are currently preparing that client's accounts on a calendar basis that you can actually still submit quarters on a calendar basis as well. So say from the 1st of April onwards. You do need to actually apply to HMRC to do that. I can actually just send a link over to the page of HMRC. But importantly, the default will always be the 6th of April. But if you want to set that to the 1st of April, for example, because that's the way you've always been preparing their records, then you will need to actually apply to HMRC to allow you to do that. Penalties, I think it's a bit much like the when sort of quarterly, VAT and making tax digital for that came in. Really, I think there's a little bit of leeway that HMRC will provide in the first sort of 12 months or less, probably actually for that matter. They're not sort of going to certainly hit people with penalties straight away. The important thing to point out there, though, is that it's a sort of penalty point type system, which was introduced for the new VAT penalties, which will all, as we understand, be applicable to making tax digital for income tax. Now we think about it, going back to the previous slide, where we potentially got multiple different records being submitted on a quarterly basis. There are potential sort of multiple opportunities to get this wrong. So if you've got 5 reporting obligations from different trades, different types of property, income, for example, 4 of those are absolutely fine, and 1 of them is not, you're still getting a penalty, despite the fact that your 80% of that is complete in good order. So again, just something to be aware of. Yes, there is a bit of leeway in relation to penalties, but there are obviously, it's not. It will be something that will be monitored and watched by HMRC. And the best thing to do, the best action to take, is just not to get it wrong, basically. So final step, and again, these quarterly submissions are not a tax return in their own right. It's really just a question of actually HMRC capturing that quarter's worth of income effectively. The actual self-assessment still needs to be completed, and that's where we do need to add in, say, employment income, dividends, you name it. We can also obviously make some deductions for gift aid, EIS subscriptions, anything of that nature. So the actual sort of final self-assessment that goes in for the 31st of January will be the final record for that client, and that will be the basis of their tax computation for that particular year. We understand that with one of the benefits potentially of the quarterly submissions is that an awful lot of the data will be pre-populated into the client's digital tax accounts, which may or may not make things easier depending on the quality of the actual sort of filings that were going in throughout the course of the year effectively. But again, that just may use a little bit of administration from our side of things for preparing this effectively. And I think that's it for me. So it's a bit of a whistle-stop tour. Just wanted to cover off a few main points that we're seeing. Seem to be areas of confusion at the moment. But any questions on that, then by all means, drop us a note.
Thank you, Rob, and thank you, Vicky. As always, very informative, and plenty of fun and games coming ahead on MTD in particular. And also, I know Vicky's very busy at the moment on explaining to clients the issues around the changes in IHT and how that's kind of turning everything on its head as far as estate planning is concerned. I will just check, see if we've got any questions. No questions have come in. So it just remains for me to say thank you all for joining us today. Hope you all found it helpful in some form or another. As I said at the start, any feedback that you've got, we're always grateful to receive it. If there are any topics you'd like us to cover in future presentations, please let us know. And I shall just leave you to say goodbye, thank you, and see you in September sometime after the summer holidays. Crikey! Right, see you all later. Cheers.